You know, when you see a plane take off, or maybe get a package delivered super fast, do you ever stop and think about everything that has to happen behind the scenes? All the logistics, the equipment.
Oh, totally. It's this massive, almost invisible world supporting the airlines and cargo companies we do see, like a whole hidden ecosystem.
Exactly, an ecosystem. And today we're going to pull back the curtain on one of the players in that world.
A really interesting one, actually. Air T, Inc. Maybe not a name everyone knows.
Right, not a household name, but they're this holding company, pretty dynamic, working across aviation and industrial services.
And we're basing this deep dive on their latest 10K, their big annual financial report.
Which gives us and you this fantastic window into how they operate complex stuff.
Yeah, it is. So our mission really is to unpack Air T's different business parts, see how they connect, especially that big relationship with FedEx we need to talk about.
Uh-huh. And look at their financials, the risks they face, how they're run.
Basically cut through all the corporate jargon and give you the clear, essential takeaways. Sound good?
Let's do it. Okay, so Air T, Inc. What's their main goal, their sort of core idea?
Well, at its heart, the goal is strategic diversification. They want to spread out where their earnings come from and, importantly, compound their free cash flow per share over the long haul. That's the holding company playbook, really.
Diversify and grow cash flow. But like you said, it's a holding company. So how do they actually do that? What are the moving parts?
That's where things get interesting, especially lately. They actually updated how they describe their main business segments. Happened in the fourth quarter of fiscal 2025, just to make it clearer what each part actually does.
Okay, alignment. Makes sense. Any big changes?
Yes, actually. They specifically pulled out digital solutions as its own segment, signaling it's a key area for long-term growth now, whereas before it was kind of tucked away.
Interesting. So 4 main pillars now. What's the first one?
Overnight air cargo. Pretty much what it sounds like, air express delivery services.
Okay, pillar 2.
Ground support equipment. So manufacturing and providing specialized gear. Think mobile de-icers, lifts, that sort of thing.
Right, the stuff you see around airports. And number 3.
Commercial aircraft, engines, and parts. This is a big one. Managing, leasing aviation assets, supplying components, repairs, the whole life cycle.
Okay, comprehensive. And the 4th is the new one.
Exactly. Digital solutions. This is about developing and selling digital aviation services. Think market data, software. And the key here is they're aiming for recurring subscription revenue, a different model.
Right, subscriptions, different from selling a de-icer or leasing a plane.
Totally. And then there's also a kind of central corporate and other piece. It acts as the capital allocator, holds some smaller interests, standard holding company structure.
Got it. And how are they measuring success across all these different businesses?
The report says they look at operating income, or loss, obviously, for each segment, and also adjusted EBITDA.
Right, earnings before interest, taxes, depreciation, amortization, adjusted. Basically trying to get a sense of core operational profit, yeah.
Precisely. Stripping out some of the noise, the non-cash items.
Okay, so that's the structure. Now let's dive into those segments. Where do they really operate, and maybe where are the pressure points?
Yeah, let's start with what's probably the most critical segment, operationally speaking.
The overnight air cargo one.
That's the one. Because this is where you see this intense dependency. It really defines a huge chunk of their risk.
Okay, so how does it work? Who are they working with?
It's all about FedEx. Their subsidiaries, MA and CSA, they operate planes under what are called dry lease agreements with FedEx. These were renewed back in June 2021, and they're set to run until August 31st, 2026.
Dry lease meaning?
FedEx basically decides the plane type, the routes, but MEC and CSA handle everything else, pilots, maintenance coordination, operations.
Gotcha. And the report mentions a really specific reimbursement model here, right? Something about costs.
Yes, this is unique. FedEx reimburses MA&E and CSA for certain big costs, fuel, landing fees, third-party maintenance, parts. But here's the kicker. It's reimbursed without any markup.
No markup at all. Wow. So how does that affect how we should think about their revenue?
It means a chunk of their reported revenue for this segment isn't really generating profit in the traditional sense. It's just cost pass-through.
Right. It inflates the revenue number compared to the actual margin they make on the courser.
Exactly. It's more like a cost-plus setup for those items.
Yeah.
Which leads right into the big issue.
The revenue concentration?
Oh, yeah. It's stark. FedEx accounted for about 92% of this segment's operating revenue in the last fiscal year.
92%.
And that translates to roughly 39% of Air T's entire consolidated revenue from one customer.
That's a massive dependency. And it's not new, right? They've been with FedEx a long time.
Since 1980, it's a very long-standing, very deep relationship.
So what kind of fleet are we talking about here? How many planes under this FedEx deal?
As of March 31st, 2025, they had 103 aircraft under these dry leases. Various types of Cessna Caravans, some newer Sky Couriers, ATRs.
And the report mentioned parked aircraft. Soft parked, hard parked. What's that about? Is it just storage?
It's a bit more strategic than just storage, actually. It shows how they manage fleet flexibility.
Okay.
Soft parked means the plane is still under the FedEx agreement. They get a reduced administrative fee. Air T maintains it, but it's not flying routes. Ready to go, basically.
Right.
Hard parked means it's really stored. They get a tiny storage fee, no admin fee. It's not operated.
So it lets them scale the active fleet up or down with demand without totally getting rid of the planes.
Exactly. It's about managing costs and assets smartly in a fluctuating market. Pretty clever, really.
And these subsidiaries, MAC and CSA, they have the necessary FAA certs, Part 121 and 135.
Yeah, they hold various certifications. Part 135 lets them fly smaller planes, like the Cessna Caravan with about 7,500 pounds of cargo.
Right.
Part 121 is for larger aircraft, like the ATRs, which can carry over 20,000 pounds.
Giving FedEx a lot of flexibility across their network, from small towns to bigger hubs.
Precisely, and competitively. It's a niche space. MDay and CSA are two of only 8 FedEx feeder carriers in the U.S. Industry data is tough to get because competitors are often private, but Air T's management believes MC and CSA together are the biggest contract carrier of this type.
Okay, that paints a clear picture of the cargo segment. Let's shift gears to ground support equipment, or GSE.
Right, the GGS subsidiary, Global Ground Support, based out in Kansas.
And it's not just de-icers, although that's a big piece.
True. De-icing equipment was about 72% of GGS revenue last fiscal year, so yeah, it's major. But they also make things like scissor lifts, decontamination units for military and civilian use, tow tractors, glycol recovery vehicles, a whole range.
And they're innovating, too, not just making the same stuff.
Yeah, the report mentions improvements like single-operator de-icers, which is more efficient, also a patented de-icing fluid blend system, and a more efficient forced air system, plus customization options.
Makes sense. Now, this market must be tied to the airline industry's health, right? And weather.
Absolutely. Airline finances are key. And yes, weather is huge, which leads to distinct seasonality.
Lower revenues in the spring and summer quarters, I assume?
Generally, yeah. Fourth and first fiscal quarters tend to be lower because airlines usually buy and take delivery of de-icers before the winter season hits.
Does that create challenges for GGS? Managing production, cash flow?
For sure. You've got to ramp up for peak demand, but manage leaner periods. That's where strategic contracts help smooth things out.
Ah, like the Air Force contract mentioned.
Exactly. They landed a big contract with the U.S. Air Force for de-icing trucks back in October 2021. If all the options get picked up, it runs through October 2027. That provides a nice, steady, non-seasonal revenue baseline.
Okay, good strategic move. Let's move to the third pillar. Commercial aircraft, engines, and parts. Sounds like a mouthful, but important.
It really covers a lot. Managing and leasing planes and engines, supplying spare parts from dismantled aircraft, selling those parts, overhaul and repair services.
So kind of cradle to grave for aviation assets.
In a way, yeah. And they do this through several specialized subsidiaries.
Like WSI, Worldwide Aircraft Services.
Right. They acquired WSI in January 2023. It's a repair station certified for various planes, does inspections, maintenance, refurbishment, structural repairs.
And then there's Jet Yard down in Arizona.
Yeah, Jet Yard and Jet Yard Solutions in Marana, Arizona. They do aircraft storage, maintenance, and disassembly parting out planes.
And you mentioned the Arizona climate is good for storage.
Yeah, the dry desert climate is ideal for preserving aircraft long term. It's a natural advantage for that location.
Seems like there could be some real synergy there. Store a plane, maintain it, then maybe part it out if needed.
Absolutely. The parts taken off by Jet Yard could then be sold or repaired by their other subsidiaries.
Like Airco.
Exactly. Airco focuses on parts, sales, exchanges, overhaul, and repair. They hold FAA and ES certs, European certs too.
And Worthington Aviation.
Similar, but maybe more global. A supplier of spares and maintenance, 247 support, locations in the U.S., U.K., Australia. They also have FAESA certified repair stations. It's a whole network.
Creating a pretty integrated value chain for aircraft assets.
Definitely. And this segment also holds some of their unconsolidated investments.
Right. The Crestone ones, Skim and CJV.
Yeah, Crestone Asset Management and Crestone JV TIC. It's a joint venture focused on buying and leasing aircraft and engines. Air T has a 90% economic interest in CAM's asset management part.
Okay, complex, but clearly a significant part of their business. Now finally, let's talk digital solutions, the newly highlighted growth area.
Yes, and this feels like a different direction for them, doesn't it?
It really does. It's not physical assets in the same way. What are they actually developing?
Things like market data services for air cargo, providing insights, trends, and cloud-hosted software to help aviation businesses. The example given is automating quotes for aftermarket parts sellers.
Okay, so tools for the industry, and the big difference is the revenue model.
That's the key. They're aiming for recurring subscription revenues here. Predictable income.
Which is very different from selling a piece of equipment or leasing an engine for a fixed term.
Totally different. It's potentially a hedge against the cycles in their other businesses, the big capital needs. It feels like a strategic move towards, future-proofing.
A modern revenue stream.
Yeah.
Interesting. Okay, so we've got the lay of the land operationally. Let's pivot to the financials and the risks, the numbers.
Right. Numbers always tell a story. And here, it's a bit of a mixed bag, showing those different dynamics at play.
That's so. What did the operating income look like comparing the last 2 fiscal years?
Well, overall, total segment operating income did go up from about $8.7 million in FY24 to $11.1 million in FY25. And the company's total operating income also increased from $1.26 million to $1.91 million. So positive direction overall.
Okay, sounds good. But you said a mixed bag. What's happening within the segments?
Yeah, when you dig in, the commercial aircraft engines and parts segment had a really strong year. Its operating income jumped by almost $3 million.
Wow, okay. That's driving a lot of the overall increase.
It is. And ground support equipment also improved. It reduced its operating loss by about $343,000. So, heading in the right direction.
But
the overnight air cargo segment actually saw its operating loss increase by about $500,000.
Despite the high revenue concentration. Or maybe because of the cost structure?
Could be related to the cost structure. Parked aircraft fees, maybe investments.
Yeah.
The report doesn't specify the exact driver for the increased loss in the text we have.
Okay. And the new digital solutions segment?
Also saw a bigger loss by about $400,000, which isn't entirely surprising, for a new growing segment often requires upfront investment.
Right, investment phase. So it really highlights that the asset management part is the current profit engine, while the core cargo and the new digital parts are lagging or investing.
That seems to be the story the numbers are telling right now, yeah.
Anything interesting on the tax side?
Yeah, they have negative effective tax rates, minus 8.5% in fiscal 2025, influenced by things like foreign tax rate differences, valuation allowance changes, and importantly, they have significant net operating losses they can carry forward.
Okay. And you mentioned something earlier about inventory valuation being tricky, a critical audit matter.
Yes. That basically means the auditors flagged it as requiring really complex estimates and judgment from management.
Why complex?
Think about valuing used aircraft parts. You have to estimate future demand, sales patterns, how much it'll cost to refurbish them, get those estimates wrong, and the value of your inventory on the books could be significantly off. It's a big judgment call area.
Right, that makes sense. Okay, let's talk debt and flexibility. How leveraged are they?
As of the end of March 2025, they had about $35.3 million in outstanding senior and subordinated debt.
And the report mentions these trust-preferred securities, TRUPS. What are those exactly?
They're kind of a hybrid instrument, technically preferred securities, but they're mandatorily redeemable, so they sit on the liability side of the balance sheet.
Okay. And what's special about them?
The interesting feature is they allow Air T to defer interest payments for up to 20 consecutive quarters. That's 5 years.
5 years of potentially not paying interest? That sounds like a lot of flexibility. Any catch?
Oh, yeah. If they do defer interest, they generally can't pay dividends on their common or preferred stock, with some exceptions.
So it's a safety valve, but using it impacts shareholders directly.
Exactly. And the company is very clear in the report. They currently have no intention of using this deferral option, but it's there. A financial cushion, if you will.
Got it. And standard stuff like loan covenants, they have those too.
Yep. Various loan agreements with the usual financial covenants, debt service coverage ratios, leverage limits, minimum net worth requirements. They monitor these regularly.
Okay, standard banking practice. Now, let's really focus on the risk profile. How do they manage all this? What keeps them up at night?
Well, number one, underlined, bolded, flashing lights, is that FedEx dependence.
We keep coming back to it, that termination clause. 90 days notice.
Okay.
Or even 10 days for specific planes.
Yeah. It's a huge vulnerability. And the report is starkly honest about it. It says that As of the report date, based on the current conditions like FedEx being way more than 60% of NBC CSA revenue, and basically their only customer FedEx would be permitted to terminate the agreements under those terms.
Wow. So the conditions allowing termination are actually met right now? That feels precarious.
It does. Now, obviously, there's a long relationship there, mutual dependence to some degree, but the contractual right exists. It's the elephant in the room.
Is there any sign they're actively trying to change those specific conditions, like get another major cargo customer for MPC CSA?
The report focuses on diversification at the holding company level across the four segments. It doesn't explicitly detail a strategy within the cargo segment itself to reduce the percentage reliance on FedEx to get below that 60% trigger, for instance. It frames the overall diversification as the mitigation.
So the mitigation is having the other segments, not necessarily fixing the dependency within the cargo segment itself.
That seems to be the implication, yeah. Relying on the portfolio effect.
Okay. What other big risks are there? External stuff.
Definitely. Anything that it's FedEx's business can ripple through to Air T. Global economic slowdowns, volatile fuel prices, changes in trade policy, disruptions to airports or infrastructure.
Makes sense. And operational risks within their own businesses.
Sure. We mentioned the seasonality of the GSE segment. There's also the risk and cost involved if they have to repossess a plane or engine from a lessee who defaults. That can get messy legally and logistically, dealing with liens and such. And with acquiring businesses and properties, there's always the potential for hidden environmental liabilities to pop up later.
Right, standard M&A risk. What about newer risks like cybersecurity, especially with that digital solutions segment growing?
They actually seem quite proactive here, which is interesting. The report details a whole program.
Oh, yeah. Like what?
There's a senior director of tech infrastructure and ops who oversees it and reports directly to the CEO. That shows it has top-level attention.
Okay, good sign.
The board's audit committee has oversight. There's mandatory cybersecurity training for employees. And they use third-party audits, SOC1 audits, for key service providers they rely on. It sounds like a multi-layered approach.
That does sound pretty robust. Have they had any breaches?
The report states that no material cybersecurity threats impacting their business strategy or financials have been identified in the last 2 fiscal years. So, seems effective so far.
Good to hear. Any other risks worth mentioning? Growth itself? Compliance?
Yeah, the usual risks that come with growth and acquisitions, integrating new businesses can be tough. It distracts management, costs can overrun. And compliance is always key in aviation and international business. Adhering to anti-corruption laws like the FCPA, FAA regulations. Slip-ups there can mean big fines and reputational hits.
Okay, a complex web of risks. Which brings us to governance. How do they ensure accountability and proper oversight?
Well, fundamentally, the CEO and CFO have to personally certify the effectiveness of their disclosure controls and internal controls over financial reporting.
That sign-off process, what does that really guarantee for investors, for you listening?
It provides reasonable assurance, not absolute, but reasonable, that the financial reporting is reliable and information gets disclosed properly. It puts personal accountability on the top execs.
Okay. And they have rules about trading stock, insider trading.
Yes, a pretty strict policy. No trading on material non-public, obviously. They have specific blackout periods around earnings releases when insiders cannot trade. And even outside those periods, trades usually require pre-clearance from the general counsel.
Pre-clearance, okay.
Yeah, and trading is generally only allowed during specific window periods, typically starting the 3rd trading day after results are announced and lasting for 30 days.
So tight controls. Any other interesting policy?
The policy also prohibits insiders from holding stock in a margin account or pledging it as collateral. That's to prevent forced sales during a blackout period if there's a margin call.
Smart. And what about clawbacks if something goes wrong with the accounting?
They have a clawback policy, too. It lets the company recover erroneously awarded compensation from executives if there's an accounting restatement due to noncompliance. It aligns with NASDAQ rules and basically means execs might have to give back bonuses or incentive pay if the numbers they were based on turn out to be wrong. Accountability.
Okay, so controls, certifications, policies. The standard toolkit for corporate governance seems to be in place.
It appears so, yes.
Yeah.
Framework for accountability.
All right, so let's try and pull this all together. We've covered a lot of ground on Air T.
Yeah, we have. And what emerges, I think, is this picture of a genuinely complex holding company. It's strategically diversified, operating in these really critical interconnected sectors: cargo, ground support, asset management, digital.
Apples.
And it's a big but. Despite that diversification across segments, there's still that profound reliance on one single customer, FedEx, in their biggest traditional segment. Right. And they operate in markets that are just inherently volatile, tied to the economy, tied to the weather, fuel prices.
So you've got this tension, right? Strategic diversification on one hand, trying to spread risks.
Balanced against this major customer concentration and these built-in market swings on the other.
Which leads to a final thought, maybe something for you, the listener, to chew on after we wrap up.
Considering that, balance the diversification effort versus the FedEx reliance and the market volatility, what do you think could be the most critical innovation for a company like Air T?
Yeah, what kind of breakthrough, maybe technological, maybe operational, maybe a totally new business model could really transform them? Something that could genuinely future-proof the company against those core challenges.
Definitely something to ponder.